2015. I can speak to that strictly in terms of the domestic market. We think we're in a pretty fairly valued market with the S&P possibly drifting up 9 to 10%. What's interesting and different is we're going to now see really what the economy has. The training wheels are coming off, supposedly no more artificial stimulation, and we'll see what's really going to drive this thing. So my guess is it's going to be earnings driven and momentum driven, where you can find, the next GoPro, trading at 20, 30 times earnings that can really grow in niche markets. We think that the other thing that will be hard to fathom and should cause a bit of a correction is when we finally see a reversion to a normal interest rate environment and rates start to go a little bit higher next year, and no one knows how high, or probably remembers what that looks like, but we think valuations will be impacted by that fear as it emerges, we think sometime in the second quarter. We just don't see that kind of leverage across the system that we had with this in 07. That's a key difference. The other difference is earnings growth looks to be a bit more broad-based and a bit solider across all the S&P sectors right now in our view. So we don't think there's anywhere near the downside in the market due to those factors. The one thing that does keep us up at night is the magnitude of the leverage on the New York Stock Exchange in margin accounts. That is at record levels, and that connotes a lot of hedge funds are levered and possibly in the same trades, as we saw with some of the inversion unwinds and the correction that followed after that. So we're a bit concerned that there's some stealth high leverage out there in some hedge funds, but we don't think it can derail the whole market, at least at this point. Active versus passive, I think there's two answers to that question. There's a short-term answer, and then there's your secular answer. We all know from the books that percentage-wise, depending on your asset class, you want passive managers. You've got a better batting average on large caps with passive managers, keeping those costs low. Conversely, with small cap managers, you have a better batting average by looking for those emerging managers that have the strategy, that have the discipline, and can prove it in good and bad times. Now we're in a situation with the market where it is today. We just came off the fourth worst sell-off we've had in the last 15 years in the U.S. market. Small caps, it was liquidity prejudice. So the smaller your cap, the worse you were down. Stocks that had capitalizations less than $250 million, down nearly 50%. I hope none of you felt that the way I did. Okay? So, what does that mean? As we've seen historically, with the percentage of stocks that are below not making money, reaching what they have in this cycle, within 6 months, the Russell 2000 has performed 35 to 60% total return within that 6-month period. So my short-term bet is that history will repeat itself, and small caps, Russell 2000 stocks that have been beaten down will regress at least to the mean, and history will repeat itself and get a very healthy return. So I urge each and every one of you to seek out a small cap emerging manager as soon as possible. I've got a very brief answer to that absolute versus benchmark returns. It depends on the client. If you're an individual high net worth investor, you're wanting usually absolute returns. That's what you care about predominantly. In this environment and this market, which has been really a stealth bear market with 70% of all stocks down for the year, I would guess that if you're performing against a benchmark, i.e. the S&P, and you're investing in big caps, you're not looking too bad. But if you're an absolute manager, you've got some explaining to do. You got to talk about why you're down in the S&P, and that's, you know, that's not a fun conversation to have. So hopefully this mean reversion happens pretty fast. Well, Matthew, I'm looking out in the room now, and as always, you never see it. It's the pink elephant or the whatnot. So we can only speculate what could derail this picture. And I'll just share with you what keeps me up late at night, besides all the research we do. It is the leverage, and it is the bankers. On the leverage side, I refer to the amount of leverage on the New York Stock Exchange right now, and I honestly don't know where that is or how that will unfold. Is it a carry trade? Is it some off-balance sheet, you know, VIE, you know, exposures? Is it, you know, what is it? We don't know, but we do know volatility has really picked up in the last month. It's increased like 40%. So, having figured out, I don't know the answer. I'd be happy to hear anyone's opinion on that. The other part of the equation that keeps me up worried is the bankers. And I mean the investment bankers right now. We just had the largest IPO of all time, Alibaba, 160 billion market cap that was floated. And lo and behold, the market, but in the last 3 weeks has gone down right after that, down about 9%. So it seems to me, with a lot of IPOs and the calendar getting bigger and bigger and bigger, just how much can this market withstand? So my concern is the dilution of the upside by issuance of new equity capital, and hopefully a lot of those deals are getting reduced and deferred. That's what I'm worried about. Closing comments. Just with look at managers, it's the same way we look at equities or stocks. Are you comfortable with the strategy? Does it make sense? Is there transparency? Can you see what's going on? Is it repeatable over the long term, or is it more trading driven? And what are some of the competitive advantages of the strategy? Are they repeatable? Are they discernible? And finally, relationship with the manager and scalability. Do you want to invest with a manager that's got the time and the expertise to sit down and articulate during good times and bad times what the strategy is and what is going on, what their view is of the market? On the dollar, it really depends on the source of the strength. For example, if it's higher interest rates, rising rates relative to other economies, I think there could be significant risk in our equity market, and here's why. This is the ultimate carry trade, right? Isn't it? This is where the return is. This is where the momentum is, and this is where zero interest rates are. Still, isn't this the carry trade to borrow and then buy here in the U.S.? So this could be part of the 800-pound gorilla. You never know. That's a great question. I'm the wrong millennium. We're Millennium West Coast. We're small cap. I think I know, and I'll answer that for them since they're not here. We would suggest that you greatly diversify your assets into many different multi-class asset managers, not knowing the risks that are out there right now and the amount of leverage, particularly if these are multi-billion-dollar hedge funds right now that are all wrapped up in many of the same trades. So diversification can't hurt.